Usually when we talk about a major financial crisis, there's this underlying expectation of visibility, like
Right.
a massive storm system, right?
Right, yeah. You can see it coming.
Exactly. You see the dark clouds rolling in on the horizon. You see the subprime mortgage defaults piling up on the evening news. You see the Lehman Brothers executives carrying those infamous cardboard boxes out of their Manhattan offices.
Yeah, everyone collectively points at the television and says, well, there it is. There's the problem.
Right. It's tangible.
It is. I mean, the human brain is wired to process a threat when there's a physical building collapsing or, a literal line of people wrapping around a bank trying to withdraw their savings.
It's terrifying, but it's entirely legible. You can read the disaster,
Right.
but then you step into the world of global currency markets and sovereign debt, and suddenly that weather radar is completely broken.
Completely useless, yeah.
We are looking at a financial landscape right now, in May of 2026, that is effectively invisible to the naked eye. We're standing on a fault line. The tremors are absolutely starting to rattle the floorboards. But if you only look at the surface...
Like the daily Dow Jones ticker?
Yeah, exactly, the daily ticker. If you only look at that, you cannot see the massive tectonic plates shifting underneath.
And that's the defining characteristic of what we're analyzing today. The most dangerous systemic risks are the ones that don't look like risks at all, until the very last second.
Right.
We're dealing with a mechanism that is entirely obscured by layers of international banking jargon, cross-border derivative accounting, and, central bank policy.
Which is exactly why we're doing this deep dive today. We have a massive stack of sources in front of us. We're pulling from macroeconomic analysis, real-time Forex trading data, geopolitical intelligence reports, and expert breakdowns to decode a mystery that has a literal $100 trillion price tag attached to it.
Yeah, a number that large almost paralyzes the imagination. I mean, think about it like this. 1 million seconds is 12 days. 1 billion seconds is 31 years.
Oh, wow, okay.
And 1 trillion seconds is 31,000 years.
That is insane.
Right. So we're talking about $100 trillion.
Yeah.
It's just an abstraction until you realize what that money is actually doing in the real world.
And what it's doing is the core of our mission for you today. We want to explain to you exactly why the chaotic, violent, and completely unpredictable movements of the Japanese yen that we're witnessing right now are not just some, distant Wall Street abstraction.
They're highly relevant.
Extremely. They are the unseen foundation propping up your 401k, your pension, and those high-flying tech stocks you probably hold in your portfolio right now.
Right.
Imagine discovering that the foundation of your home isn't made of poured concrete, but is actually constructed out of highly leveraged foreign IOUs that can just legally evaporate overnight.
It's a terrifying thought. And to understand the sheer scale of the panic creeping into the markets in May 2026, we really have to look past the standard financial media. The Bank for International Settlements actually has a brilliant term for this.
Oh, what do they call it?
They call it the invisible mortgage on the global financial system.
The invisible mortgage. I like that.
Yeah, it's like the global economy took out a variable rate mortgage, and right now, the interest rate on that massive invisible loan is ticking up. And the entire global neighborhood is starting to panic because, frankly, nobody actually has the cash to make the monthly payment.
Okay, let's unpack this. Because to understand how a single currency, the Japanese yen, can essentially hold the entire world's financial system hostage, we first have to understand the trap itself.
Right.
And that starts with the mechanics of something called the yen carry trade. Now, this is not the kind of borrowing that everyday people are familiar with.
No, not at all. It is an entirely different species of finance. Let's look at the kind of borrowing that runs the real economy first. You go to a bank for a mortgage to buy a house. You have the two-party risk dynamic.
Just the borrower and the lender.
Exactly. The bank looks at your credit score, your income, and the value of the house.
And the bank's primary nightmare is just me losing my job and failing to make the payment. It's a closed loop.
Right, it's a closed loop. But the yen carry trade introduces a wildly unpredictable third party into that loop, which is the global currency market itself.
Okay, so how does the machine actually work?
Well, it works like this. A major hedge fund operating out of London or New York wants to amplify their returns. So they go to a Japanese institution and borrow a massive sum of Japanese yen. Now, keep in mind, for decades, the Bank of Japan kept interest rates artificially suppressed at zero, or in some cases, literally below zero.
Which makes it practically free money. I
Yeah.
mean, you're borrowing billions without having to pay a meaningful percentage back to the lender.
Exactly.
Yeah.
But a hedge fund in London doesn't need yen to pay its traders or buy assets in the West, right?
Yeah.
So they immediately take that borrowed yen and dump it onto the foreign exchange market, converting it into U.S. dollars.
Yeah.
So now they have a mountain of U.S. dollars. They go shopping. They buy high-yielding assets. They might buy U.S. Treasury bonds that are paying 4 or 5% interest, or they might pour that cash into high-growth tech stocks on the NASDAQ.
So on paper, it's a flawless arbitrage loop. You borrow capital at 0%, you invest that capital at 5%, and you just pocket the entire spread as pure profit.
Yeah, free money on a planetary scale.
But there's a catch.
A massive catch. The fatal flaw is that third party we mentioned. Eventually, the music stops, and that hedge fund has to pay back the original loan. But the loan wasn't in dollars, right? The loan was in yen.
Oh, right.
So if the Japanese yen suddenly strengthens against the US dollar, the cost to buy back those yen to repay the bank absolutely skyrockets.
So wait, let me make sure I've got this. If I borrowed 1 billion yen and I used it to make a 5% profit in the US stock market, but during that time the yen became, say, 10% more expensive to buy, my entire profit is gone. I'm underwater.
Worse than underwater, you owe capital you no longer possess. You took a pure financial concept, interest rate arbitrage, and you left it completely exposed to the violent swings of geopolitical currency valuations.
That sounds incredibly reckless.
It is, but the rabbit hole goes deeper, believe me. When we talk about trillions of dollars worth of yen being loaned out to Wall Street, we have to look at the source of that capital.
Right, because my assumption would be that there are, millions of Japanese retirees dutifully saving their money, depositing it into Tokyo banks, and those banks are turning around and lending those savings to Western hedge funds.
That is the textbook, classical model of banking, right? Intermediation. But the sources point us toward the reality of modern banking, which operates under endogenous money theory.
Okay, endogenous money theory.
Yeah. In 2026, Japanese commercial banks are operating with an effective reserve requirement of roughly 0.8%.
Less than 1%.
Less than 1%, which fundamentally alters the physics of lending. The bank does not sit around waiting for a Japanese citizen to deposit their hard-earned yen before they can issue a loan to a hedge fund.
So what do?
The exact moment the loan agreement is signed, the Japanese bank goes into its digital ledger and simultaneously creates a deposit and a loan asset. They are literally typing digital yen into existence.
Wow. The sources actually refer to this as the ghost yen.
The ghost yen. It is the absolute perfect descriptor. I mean, consider the sheer absurdity of this capital life cycle.
Yeah.
The currency is manifested out of thin air on a digital server in Tokyo. Seconds later, it is sold into the global foreign exchange market in exchange for U.S. dollars.
Right.
And then minutes later, those dollars are deployed to aggressively bid up the price of a tech stock in New York. The entire Western financial boom has basically been fueled by ghosts.
Wait a minute, though. If the Bank of Japan and these commercial banks can just create this digital yen out of thin air, who cares if the carry trade fails? I mean, it didn't cost them any physical resources to make the money, so isn't this risk entirely theoretical? If a hedge fund defaults, a bank just crosses out a digital number they made up anyway.
It's a really common intuition that thin air money means thin air risk. But that completely ignores the ironclad rules of banking capital adequacy.
How so?
Well, the limit on a bank's lending isn't the amount of deposits they hold, it's the amount of their own equity they have to put on the line to absorb potential losses. When a bank types that loan into existence, they are legally putting their own institutional wealth on the chopping block.
Ah, I see.
So if the hedge fund blows up because of a violent currency swing and defaults on that massive yen loan, the bank cannot just delete the ledger entry. The loss is violently real, and it is subtracted directly from the bank's core equity. If enough of these carry trades fail simultaneously, the bank's equity is entirely wiped out and the institution is insolvent.
So the ghost yen vanishes, but the bankruptcy is very real.
Very real. And for years, the Bank of Japan's own policies essentially forced these commercial banks to take on this insane risk. Japan instituted a negative interest rate policy, or NIRP.
Right, in IRP.
The central bank was essentially punishing commercial banks for holding on to cash. If a bank parked its reserves at the Bank of Japan, They were literally charged a fee.
So it was a massive financial cattle prod.
Exactly. Forcing these institutions to push this newly minted ghost yen out the door at all costs. They were functionally paying the rest of the world to take their currency and use it to fund global asset bubbles.
Okay, so we've established the mechanics of the trap. We have an entire global financial architecture built on free conjured capital that is rigged to detonate the second the underlying currency valuation shifts. But we need to quantify this, because when the sources try to calculate exactly how much of this ghost yen is circulating in the world right now, the numbers kind of defy standard comprehension.
They really do. To grasp the sheer magnitude of the exposure, we have to conceptually slice the iceberg. When standard financial television networks discuss the carry trade, they are almost exclusively focused on the visible tip.
Okay, let's start at the very top of that iceberg then. What is the most visible layer?
The tip represents roughly $1 to $2 trillion.
Okay.
This is the realm of purely speculative, fast-moving capital. This is the aggressive hedge fund manager borrowing yen to leverage a bet on Nvidia stock, or a proprietary trading desk using the spread to buy Bitcoin. It's highly leveraged, it moves at the speed of light, and it is the absolute first layer to panic when the wind changes direction.
I mean, $1 to $2 trillion is a staggering amount of money. But in the context of the entire global financial system, central banks can theoretically manage a $2 trillion fire. But that's just the visible surface. What sits directly underneath those speculators?
The middle layer is significantly heavier. We're looking at roughly $4 to $6 trillion in institutional unhedged debt.
Wait, unhedged, meaning they deliberately chose not to buy insurance against the currency moving against them.
Exactly. This layer is dominated by massive, slow-moving entities like the Japanese state pension funds. They collect the retirement savings of the Japanese populace. But domestic yields in Japan have been zero for decades.
So to make any money.
Right. To actually generate a return for their pensioners, they take those yen, convert them to dollars, and buy U.S. Treasury bonds. Now, a prudent investor would buy a currency hedge, a financial contract, that protects them if the yen gets stronger.
The hedging costs money, right?
Yeah, it does. It eats directly into the yield of the bond. So, to maximize their return, these massive pension funds simply operate without a net. They're entirely nakedly exposed to currency volatility.
So between the fast money hedge funds and the unhedged pension funds, we are up to roughly $8 trillion of risk. I mean, we're getting into systemic danger territory now. What constitutes the bedrock of this visible iceberg?
The bedrock is an estimated $10 to $20 trillion in broad global carry. Yeah, this is where the speculative nature of the trade bleeds into the actual plumbing of the real, tangible economy.
Yeah.
We're talking about massive multinational corporations.
Like who?
Well, imagine a massive manufacturing conglomerate based in Europe or the US. They need to build a new factory or fund a global supply chain expansion. They don't borrow in their local currency, they borrow in yen, simply because Japanese capital is the absolute cheapest on the planet.
So they are embedding currency risk directly into the operational overhead of the global supply chain.
Exactly.
$20 trillion. That is a colossal mountain of debt entirely dependent on the Bank of Japan keeping rates at zero. But in our introduction, we promised to decode a $100 trillion mystery. Even if we stack the hedge funds, the pensions, and the multinationals, we are only at a fraction of that number. Where's the rest of the exposure?
The true terror, the massive jagged expanse of the iceberg hiding completely in the pitch black water below the surface, is $100 trillion in outstanding off-balance sheet foreign exchange swap debt.
Off-balance sheet. The sources refer to this specific mechanism as a perpetual refinancing machine. Now, an FX swap is not a traditional loan agreement, is it?
No, functionally it acts like debt, but structurally it is a derivative contract, which is where the real danger lies.
How so?
Let's say a giant European pension fund decides they need exposure to Japanese assets, or they need yen funding. Walking into a commercial bank in Tokyo, filling out loan paperwork, dealing with cross-border banking regulations, and securing a physical loan is incredibly slow and bureaucratic.
All right, and institutional capital despises friction.
They hate it. So instead, they go to the foreign exchange desk of a massive global bank and execute an FX swap. The European fund says, I have 10 billion US dollars. I will swap them with you today for the equivalent in yen. In exchange, I legally agree to swap the yen back for my dollars at a predetermined exchange rate on a specific date in the future.
It's essentially a temporary currency trade with a legally binding return policy. Like, I owe you the currency back in the future.
Yeah, in terms of actual cash flow and obligation,
Yeah.
it is entirely indistinguishable from taking out a massive loan. But because of how global accounting standards are written, this transaction is classified as a derivative contract rather than a traditional debt instrument.
Let me guess. Therefore, it does not appear on the main balance sheet of the institution.
You guessed it. It is buried in the obscure footnotes of their financial filings. We have constructed a $100 trillion mountain of systemic obligation that is completely invisible to standard debt to GDP metrics.
That's terrifying. And when you look at the data in these sources regarding the maturity dates of these swaps, it gets incredibly bleak.
Yeah, the Bank for International Settlements has flagged this specific metric as a massive vulnerability. Approximately 75% of these FX swaps have a maturity date of less than a single week.
Wait, less than a week.
Less than a week.
You have global institutions managing a $100 trillion pool of capital, and the bill comes due every few days. How do they possibly pay that back?
They don't. That is the dark secret of the perpetual refinancing machine. Nobody actually settles the principal. The moment the swap is set to expire on a Thursday, the institution simply enters into a brand new swap agreement to push the obligation to the following Tuesday.
They just roll it over.
They roll it over constantly.
Here's where it gets really interesting, because it is functionally identical to someone holding a $100 trillion credit card balance. And instead of ever paying down the principal, they just continuously transfer the balance to a newly opened credit card every 3 days to avoid default.
That is the exact mechanism. And for the last 2 decades, transferring that balance was effectively free. Because Japanese interest rates were anchored at zero, the cost of executing that swap, the cost of rolling the debt over, was negligible. The machine could just spin infinitely.
Right.
But that brings us to the pinprick that is currently popping this entire atmospheric bubble in May of 2026.
The 1% pinprick.
Exactly. In April 2026, the Bank of Japan, finally facing insurmountable domestic inflation pressures, capitulated. They pushed their benchmark interest rates up toward 1%.
So suddenly, doing a balance transfer on a $100 trillion credit card isn't free anymore.
Not at all. The friction cost to renew that massive off-balance sheet debt has become absolutely paralyzing. If an institution can no longer afford the higher interest rate premium to roll their swap over to the next week, they are forced to actually settle the contract.
Meaning they have to pay it off.
Yeah, they have to go into the open market, locate physical yen, buy it, and deliver it to satisfy their obligation.
It's a terrifying setup. The FX swap market right now is basically a $100 trillion game of musical chairs played at light speed.
That's a great way to put it.
Yeah. I mean, as long as the music plays, meaning interest rates stay at zero, everyone has a seat. It was a blast. But at 1%, the Bank of Japan didn't just stop the music. They permanently removed half the chairs.
And when the chairs are removed, the scramble for survival begins. And the first place we can observe the sheer panic of that scramble, the place where the music stopping actually detonates inside the portfolio of the average listener, is right on the floor of the U.S. stock market.
Which is where we see the most visceral symptom of this underlying disease, right? The fierce inverse correlation between the Japanese yen and the NASDAQ.
Yes.
Because up until this point in our dive, this might sound like, I don't know, an esoteric dispute between London hedge funds and Tokyo bankers arguing over spreadsheet footnotes. But the sources highlight an incredibly aggressive, mathematically observable anomaly in the stock market.
Macroeconomic analysts refer to this specific chart as the smoking gun of modern global finance. If you plot the value of the Japanese yen on a chart and you overlay the value of the U.S. tech-heavy NASDAQ index over the last 10 to 15 years, the inverse correlation is undeniable.
They move in exact opposition.
Violently so. When the Japanese yen is weak, meaning the cost to borrow the currency is incredibly cheap, speculative investors gorge themselves on yen-denominated loans. They immediately convert that cheap capital to dollars and pump it relentlessly into Silicon Valley tech equities, artificially forcing asset prices into the stratosphere.
And the NASDAQ just breaks record after record.
Right. But the moment the Bank of Japan hikes rates to 1% and the yen begins to strengthen,
the physics of the trade immediately invert.
yes, those cheap loans suddenly become dangerously toxic. The investors are severely underwater on their carry trades. The prime brokerage desk calls the hedge fund manager and issues a margin call.
Meaning they demand more cash.
They demand immediate additional collateral to cover the gaping hole in the account. And to survive the margin call, the hedge fund is mathematically forced to mass liquidate their most liquid, profitable assets.
Which are the tech stocks.
Exactly.
Yep.
They sell their U.S. tech stocks, take those dollars, convert them back to yen at a terrible exchange rate, and pay off the loan before the brokerage forces them into bankruptcy.
The sheer multiplier effect detailed in the sources is staggering. I mean, a mere 2% jump in the value of the Japanese yen has been shown to precipitate a 5% massive drop in the Nasdaq in a single trading session.
2% of currency movement triggers 5% of equity destruction.
Yeah.
It is a leverage multiplier that entirely reframes the narrative of the last decade of Western financial growth.
Right, because for the last 10 years, the prevailing cultural narrative has been that the sky-high, multi-trillion-dollar valuations of these Silicon Valley tech monopolies were purely the result of, organic American innovation, brilliant coding, and unparalleled entrepreneurial dominance.
But the cold, hard data suggests a much more sobering reality. Those astronomical valuations were heavily subsidized by a mountain of unpaid Japanese debt. The ghost yen was the unseen rocket fuel propelling the American tech sector.
Wow.
Yeah, in many profound ways, the U.S. stock market has ceased to be an accurate barometer of domestic corporate health. It has simply become a derivative of Japanese monetary policy.
Which forces a very uncomfortable question for the listener. I mean, if my basic, incredibly boring, supposed to be safe retirement index fund, or my 401k, is packed with these top 10 tech stocks, which by definition almost all index funds are, am I effectively holding the bag for a London hedge fund's reckless Japanese currency gamble?
Unfortunately, the architecture of the modern financial system guarantees that you are.
Seriously.
Because of the extreme interconnectedness of global liquidity, the real economy, the everyday retail investor saving for a house or retirement ultimately absorbs the systemic crash risk. You may have never traded a single yen in your entire life. You may not even know what the exchange rate is.
I certainly don't follow it daily.
Right. But because the mega funds that dictate the price of equities use leveraged yen to bid up the exact same stocks sitting in your retirement account, when those funds are forced into a chaotic liquidation event, the value of your portfolio plummets right alongside theirs.
So the hedge fund's margin call becomes a 5-year delay on my retirement.
Yes.
Okay, so if Wall Street is panic selling their tech stocks to cover these yen loans, what happens to the cash? It doesn't just sit there. This massive liquidation bleeds directly into the U.S. bond market, creating a bizarre anomaly that analysts are tracking right now.
And this is the critical juncture where a painful stock market correction metastasizes into a full-blown sovereign debt crisis. To understand this anomaly, we have to look closely at Stephen Van Meter's thesis, drawn from the current May 2026 data.
Right, Van Meter's thesis.
Yeah, Van Meter frames the current dynamic as the U.S. Treasury throwing an unprecedented clearance sale on its own debt, but absolutely nobody is walking into the store to buy the merchandise.
So let's look at how this machine is supposed to operate under normal, healthy macroeconomic conditions. If the yield on a U.S. Treasury bond goes up, meaning the United States government is offering to pay a highly attractive 4% or 5% interest rate to anyone willing to lend them money, investors from all over the globe should theoretically scramble to buy those bonds.
They should, yes.
And to buy those bonds, they first have to acquire U.S. dollars. That massive demand for the currency should naturally cause the dollar to strengthen.
Yields rise, the dollar strengthens. It is the fundamental gravity of economics 101. But right now, in May 2026, that fundamental rule of gravity is breaking down before our eyes.
So?
The yields on U.S. sovereign debt are violently spiking, signaling an incredibly attractive return, but the U.S. dollar is simultaneously weakening. The higher interest rate carrot is completely failing to attract capital. Instead, capital is aggressively fleeing the system.
And the sources point directly to the culprits creating this massive demand vacuum. They refer to the two giants who are both aggressively heading for the exits, but they're doing so for completely different strategic reasons.
We're looking at China and Japan, historically the two absolute largest foreign holders of U.S. debt. Both nations are currently dumping their holdings. Let's analyze China's maneuver first. China is executing what geopolitical analysts define as a structural exit.
Meaning it's methodical, slow, and deliberately paced.
Highly calculated. Over the last 17 consecutive months, Beijing has been quietly letting its massive portfolio of U.S. Treasury bonds mature, collecting the principal and simply refusing to reinvest that capital into new U.S. debt.
Wow.
Yeah, they have systematically drawn their holdings down below the pivotal $700 billion threshold. They are actively and deliberately de-risking their entire national economy.
Because of sanctions.
Exactly. They observed the weaponization of the U.S. dollar and the profound impact of global sanctions over the last few years. And they are quietly swapping their vulnerable dependence on the U.S. financial system for the absolute security of physical gold reserves.
So China is slowly, quietly walking out the back door of the casino. But Japan's exit is entirely different. Japan is basically kicking the front doors off the hinges and sprinting out of a burning building.
Japan is executing a panicked exit. They are not liquidating U.S. debt as part of a grand multi-decade geopolitical chess match against Washington. They are selling it simply to draw breath.
Just to survive.
Right. They are dumping pristine U.S. treasuries onto the open market to acquire the hard cash they desperately need to artificially support their own collapsing currency.
The scale of this panicked liquidation is just difficult to overstate. I mean, the data indicates that on a single Thursday afternoon recently, the Japanese government intervened in the currency market to the tune of $32 billion. That is roughly 5 trillion yen.
It's massive.
Where does a sovereign entity even acquire $32 billion in physical cash on a random Thursday afternoon?
They acquire it by aggressively dumping their strategic reserves of U.S. Treasury bonds directly into the market. They take the dollars generated from that fire sale, and they use them to flood the foreign exchange market, buying up their own yen to create a synthetic floor under the currency's value.
So what does this all mean for the U.S.? If both Japan and China are simultaneously dumping billions of dollars, flooding the market and making the dollar weaker, doesn't that mean foreign investors from Europe or the Middle East suddenly get significantly more U.S. treasuries for their money?
That's the logical assumption.
Right. Shouldn't a violently weakened dollar trigger a massive buying spree from global bargain hunters?
In a vacuum, it is exactly what should occur. But it entirely ignores a terrifying psychological and mathematical market dynamic known as the falling knife risk.
The falling knife, explain that.
Why aren't massive European pension funds stepping in to buy this supposedly cheap U.S. debt? Because acquiring a cheap dollar today is absolutely meaningless to a foreign investor if that dollar is projected to lose another 10% of its value by tomorrow morning.
Oh, I see.
If you purchase a U.S. bond yielding a generous 5%, but the underlying currency you use to buy it depreciates by 10% against your home currency, your generous yield has resulted in a net negative return. You attempted to catch a falling knife and you severed your own fingers.
Ouch. And professional institutional investors do not simply guess where the currency is going. They employ complex mathematics and buy insurance policies.
Right. They utilize currency hedges to strictly cap their downside risk.
No.
But right now, the volatility in the forex markets is so extreme and the directional panic is so severe that the premium cost of purchasing that insurance is astronomical.
How astronomical?
The math, detailed in the sources, is definitive. By the time an international bank pays the exorbitant premium to hedge their currency risk on a new U.S. Treasury purchase right now, the math guarantees them a net loss of negative 1.57%.
Wait, a guaranteed locked-in loss of negative 1.57%?
Yes. The so-called bargain is a complete mathematical illusion. This perfectly illustrates the profound difference between standard value investing and genuine capital flight.
Right.
When global markets decouple to this extreme degree, investors fundamentally change their psychology. They are no longer looking at a spreadsheet asking, well, how much profit can I generate? They are looking at the abyss asking, what is the maximum amount of capital I can lose?
And this sheer panic isn't some organic accident of the free market, right? Japan isn't just blindly selling dollars into the void. They are executing these sales in the absolute shadows, utilizing a profound mastery of market microstructure and trading psychology to maximize the terror for those over-leveraged hedge funds.
To truly comprehend Japan's strategy, you must understand their deployment of stealth. Historically, central bank interventions were somewhat theatrical. A finance minister would hold a press conference and announce, we believe our currency is undervalued and we will defend it.
But Japan does none of this.
None of it. They execute completely unannounced stealth interventions.
They operate entirely in the dark.
Literally. They route their massive multi-billion-dollar buy orders through dark pools, which are private financial exchanges designed specifically to obscure the size and origin of a trade from the broader public market.
Okay.
They utilize EBS electronic broking services, which is a highly restricted top-tier interbank trading platform. And they deploy algorithmic iceberg orders.
An iceberg order being exactly what it sounds like, I assume.
Precisely. They program the trading algorithm to display only a tiny, innocuous fraction of their true trade size to the public order book, the visible tip of the iceberg, while a massive market-moving multi-billion-dollar order sits completely submerged just below the surface, waiting to detonate when a speculator triggers it.
That's wild. And the specific timing of this massive Thursday afternoon intervention was incredibly calculated, too. They didn't just pick a random day. They executed this ambush right at the onset of Japan's Golden Week.
Yeah, Golden Week is a consecutive string of national holidays in Japan. During this specific window, Japanese domestic financial markets are closed, domestic banks are shuttered, and major institutional traders are literally on vacation.
The trading floors are completely empty.
In macroeconomic terminology, market liquidity is incredibly thin. There are very few active buyers and sellers in the order book.
Why does that matter?
When liquidity is thick, it requires hundreds of billions of dollars to move the needle on a major currency. But when liquidity is razor thin during a holiday, it takes significantly less capital to violently whip the price of an asset in one direction.
So it's a force multiplier.
Exactly. By deliberately choosing to intervene when the market is empty, the Bank of Japan artificially amplifies the impact of their capital. They wait in the weeds, and they ambush the speculators when they are least capable of defending themselves.
And they specifically laid this ambush right at the 160 red line. The sources describe a 160 yen to the US dollar as a massive psychological tripwire for the market.
It is.
The moment the currency weakened to hit 160, Japan unleashed the iceberg orders, forcing the price to rapidly, violently crash down to 157.26.
And that specific engineered plunge from 160 to 157.26 is the exact mechanism that triggers the automated margin calls we analyzed earlier. This is not standard central banking. This is highly tactical financial warfare explicitly designed to violently squeeze the short sellers until their accounts break.
But as aggressive and tactically brilliant as these Golden Week ambushes are, the sources highlight a structural reality using a really powerful metaphor. These stealth attacks are not actually fixing the root cause of the crisis.
No, they are treating the symptom, not the disease. The fundamental structural problem, the fire that is actively burning down the house, is the massive structural interest rate differential between the United States and Japan.
The interest rate gap.
Right.
Yeah.
As long as U.S. Treasury yields remain significantly higher than Japanese yields, the basic laws of financial gravity dictate that capital will relentlessly flow out of Japan and into the United States. That fire is roaring at 500 degrees.
And Japan's stealth intervention
Is merely a bucket of water. The Bank of Japan possesses a highly formidable but ultimately finite war chest of foreign reserves, approximately $1.3 trillion.
Okay.
When they execute an intervention, they're essentially taking a $35 billion bucket of water and hurling it onto a 500-degree structural fire.
So it cools things off for a second.
It certainly cools a very specific patch of the floor for a brief moment, and it generates a tremendous amount of blinding steam and panic among the traders. But the structural fire continues to burn unabated all around it. Interventions are emergency handbrakes. They are not steering wheels. They can momentarily halt the momentum of the vehicle, but they cannot fundamentally alter the direction it is traveling.
Which raises an obvious strategic question, I think. If the Ministry of Finance knows they only have a finite numbers of buckets, why embrace this cloak and dagger stealth approach?
It's a good question.
If their ultimate goal is to deter speculators from betting against the yen, why not simply step up to a podium, point to their $1.3 trillion war chest, and loudly declare, we have overwhelming financial force and we will annihilate anyone who shorts our currency? Wouldn't absolute transparency scare off hedge funds more effectively than hiding in dark pools?
It seems highly counterintuitive to a Western mindset, definitely. But stealth is actually the ultimate weaponization of uncertainty. If a central bank explicitly announces their exact red lines and the exact size of their defense budget, they have given the hedge funds a concrete mathematical equation.
I see where this is going.
Right. The hedge funds can sit down, run the numbers, and calculate exactly how many billions of dollars it will require to break the central bank's defense. They will simply form a syndicate, pool their capital, and relentlessly attack the peg until the central bank runs out of money.
It's exactly what George Soros did when he famously broke the Bank of England in the 1990s. He knew their limits, and he just kept pushing until they snapped.
Precisely. But by remaining completely silent and operating in the shadows, the Japanese Ministry of Finance introduces a profound, toxic fear of the unknown into the market.
Because you never know when they'll strike.
Exactly. A trader staring at their terminal never knows if Japan is preparing to drop a $5 billion bucket or a $50 billion bucket. They don't know if the intervention is happening today, tomorrow, or next month.
It makes him paranoid.
The ministry turns the financial media and the trading desks into deeply paranoid actors who constantly second-guess their own strategies. The uncertainty itself becomes so financially toxic that speculators voluntarily close their positions purely out of psychological exhaustion and fear. The Bank of Japan essentially tricks the market into doing the government's job for them.
Wow. It is psychological warfare executed on a macroeconomic scale. And what the sources reveal is that this tactical brilliance we just watched unfold on a Thursday afternoon in May 2026. It's actually just the tiny, razor-sharp tip of a much longer, multi-generational strategic spear.
It really is.
To understand how we arrived at this precarious moment, we have to pull the lens way, way back.
To understand the true depth of the trap that has ensnared the Western financial system, we must examine the historical architecture. We have to rewind the clock back to 1985 to a pivotal macroeconomic event known as the Plaza Accord.
Right. This is the moment in history when the Western powers essentially cornered Japan, right?
It was a moment of profound economic anxiety in the West. In the early 1980s, the Japanese manufacturing engine was an unstoppable juggernaut. Japanese automakers and electronics firms were absolutely dominating global markets, severely threatening American and European domestic industries.
So they took action.
The political pressure in Washington became immense. So the G5 nations, the US, the UK, West Germany, France, and Japan convened at the Plaza Hotel in New York. The West effectively strong-armed Japan into signing an agreement that deliberately and artificially strengthened the value of the Japanese yen against the US dollar.
And what was the goal there?
The explicit goal was to make Japanese exports significantly more expensive and therefore less competitive on the global stage. The Western powers believed they had successfully neutered the Japanese economic miracle.
But instead of collapsing under the weight of a hyper-expensive currency, Japan simply executed a pivot.
They executed arguably the most consequential macroeconomic pivot of the 20th century. Instead of fighting a feudal war to keep their currency cheap, they weaponized the newly supercharged yen.
Weaponized it how?
They used their massive, newly inflated purchasing power to systematically buy up foreign assets across the globe. They fundamentally transitioned their economy from being an exporter of consumer goods like cars and televisions to becoming an exporter of raw capital.
So they became landlords, essentially.
Yeah, Japan transformed itself into a global rentier state, a nation that derives its wealth and power not primarily from domestic labor, but from owning the debt, the real estate, and the productive assets of other sovereign nations.
Which highlights a massive philosophical divide that the sources repeatedly emphasize. The fundamental difference between Western financial short-termism and Japanese strategic long-termism.
And that is the defining contrast that explains the current crisis. Western financial institutions, hedge funds, and politicians are structurally shackled to a 90-day horizon. They are obsessively focused on the next quarterly earnings report, the immediate liquidity of their portfolio, and the next election cycle.
Very short-term thinking.
Right. Japan's institutional planners, conversely, operate on a 90-year strategic horizon. They are perfectly willing to endure a decade of apparent stagnation if it secures their structural dominance in the century that follows.
So while the West was throwing a victory parade in 1985, celebrating the apparent defeat of Japanese manufacturing, Japan was quietly settling into its new role as the world's most ubiquitous discount lender, slowly and deliberately spinning a massive web of global financial dependency.
And the deeply ironic tragedy is that Western free markets walked willingly, enthusiastically, right into the center of that web.
Why? Just for the cheap money.
Exactly. Because the immediate short-term profits generated by borrowing practically free Japanese yen were simply too lucrative to pass up. This dynamic perfectly illustrates a profound economic concept known as Gresham's Law of Risk.
Okay, let's explore Gresham's Law because understanding this mechanism is crucial to understanding why the West is currently so helplessly trapped.
The classical definition of Gresham's Law, which originated in the 16th century, states that bad money drives out good.
Meaning what, exactly?
Well, if a society has two forms of currency in circulation, one made of pure gold and one made of cheap copper mixed with a little gold citizens, will inevitably hoard the pure gold and exclusively spend the cheap copper. Eventually, only the bad currency circulates.
Right, because why would you give up the good stuff if you don't have to?
Exactly. When we apply this law to modern financial risk, it means that abundant, incredibly cheap, but highly risky capital will relentlessly push out stable, cautious capital in a hyper-competitive free market.
Because the incentives completely punish caution. I mean, if I am a prudent, cautious mutual fund manager and I strictly refuse to utilize the highly volatile yen carry trade, I might generate a safe 5% annual return for my clients.
Which is respectable.
Sure. But the aggressive fund manager across the street is utilizing billions in 0% yen loans to artificially juice his returns up to 15%. In a 90-day performance culture, my clients will look at his 15%, look at my 5%, fire me, and transfer their wealth to him.
Exactly.
I am mathematically forced to adopt his highly risky strategy just to survive the competitive landscape.
The adoption of the yen carry trade was never merely an optional investment strategy for Western finance. It became an absolute structural survival mandate. The extreme risk of the currency fluctuation was systematically embedded into the foundation of Western pensions, mutual funds, and corporate balance sheets because the market offered no alternative path to competitive yield.
But looking at the global board, surely someone recognized this trap as it was being built. We discussed China earlier and how they are currently executing a slow exit from the US dollar. How did Beijing navigate the temptation of the yen carry trade over the last few decades?
China's navigation of this era provides a fascinating and stark contrast to the West. The architectural planners in Beijing looked at the euphoric rise of the yen carry trade, correctly identified it as a massive vulnerability, and decided to build an impenetrable wall.
So they just blocked it out completely.
Yes, they instituted deliberate, draconian, state-managed capital controls, a system often referred to by economists as their financial Great Wall. They deliberately kept their domestic financial markets heavily insulated from the broader global liquidity pools.
Meaning a global hedge fund cannot simply execute a frictionless trade, moving billions of Chinese yuan into Japanese yen and back again to harvest arbitrage profits. The state strictly regulates the flow of capital across its borders.
Precisely. By consciously sacrificing the immediate benefits of full financial integration with the Western free market, China successfully insulated its domestic economy from the exact Gresham's law trap that captured Wall Street.
Wow.
They intentionally missed out on the euphoric high-leverage highs of the carry trade boom. But now, as the Japanese trap aggressively springs shut in 2026, the Chinese economy is largely outside the blast radius of the unwinding leverage.
Which perfectly sets up this fascinating concept the sources refer to as the global risk pyramid. It forces a complete reframing of who is actually in danger when the system finally breaks. Let's build this pyramid from the top down. Who occupies the absolute peak?
At the very top, occupying the position of absolute leverage, sits the Bank of Japan. They control the fundamental liquidity tap. They are the sole creators of the ghost yen.
Right.
But this presents a fascinating macroeconomic paradox. Despite the fact that the Japanese government carries a massive, seemingly catastrophic national debt load, hovering well over 250% of their total GDP, their actual risk of a sovereign default is shockingly low.
Because the structure of that debt is entirely internalized, right? The sources point out that roughly 88% of the Japanese national debt is owned entirely by domestic Japanese institutions. The Bank of Japan itself owns over 50% of it outright.
It is a completely closed loop,
They literally owe the money to themselves.
which grants them absolute, unassailable control at the top of the pyramid. They have successfully retained all the systemic control while completely exporting the systemic volatility. Moving down to the middle tier of the pyramid, you find the highly leveraged actors.
The hedge funds?
Yes, the Western hedge funds, the proprietary trading desks, and the global commercial banks that utilize the carry trade to inflate their balance sheets.
And the foundational base, the massive layer holding up the entire precarious structure.
The wide, crushing bottom of the pyramid is the Western middle class and the broader global real economy. Exactly. Because Gresham's law forced the entire financial industry to adopt this risk to remain competitive, everyday citizens were unknowingly dragged into the system through their 401ks and retirement funds.
That's depressing.
So when the Bank of Japan, acting from a position of absolute safety at the top, decides to raise interest rates, The middle-tier hedge funds instantly panic and ruthlessly liquidate their assets to survive. It is the bottom tier, the everyday retail investor whose portfolio value gets decimated in the crossfire, who actually absorbs the brutal reality of the systemic crash risk.
It is an incredibly dark, almost masterful architecture. I mean, it's as if the nation of Japan has spent 40 years operating as the world's most aggressive, high-interest payday lender abroad, fueling reckless speculative gambling across the West, while simultaneously running a hyper-secure, perfectly insulated safety deposit box for itself back at home.
It is a profound strategic achievement that took decades of patient discipline to construct. They successfully outsourced the risk of collapse while retaining the operational control of the currency. And as this trap finally violently springs shut on the West in May 2026, Japan is not merely sitting back and passively observing the chaos.
No, they are not.
They are actively and aggressively constructing a massive regional fortress to ensure that the broader Asian continent survives the impending fallout.
Which brings us to a critical development that the Western media is largely ignoring. Japan is not fighting a solitary currency war. They have quietly assembled a massive, heavily armed backup team.
This development is arguably the most significant, underreported geopolitical tectonic shift occurring in global finance right now. On May 3, 2026, the world witnessed the formal culmination of what is known as the Samarkand Consensus.
The Samarkand Consensus.
The finance ministers and central bank governors from the ASEAN plus 3 nations, which comprises the 10 Southeast Asian nations, along with the heavyweights of Japan, China, and South Korea, officially pledged to collectively monitor and respond to foreign exchange market volatility.
And crucially, this isn't just a diplomatic press release offering thoughts and prayers for the Japanese yen. They have assembled real, deployable financial firepower.
They are actively preparing the groundwork to activate the Chiang Mai Initiative multilateralization.
That's a mouthful.
It is, but it's important. This is not a think tank proposal. It is a heavily funded $240 billion regional currency swap arrangement. It serves as a massive collective safety net.
So they are backing each other up.
By unifying their reserves, this coalition is sending a terrifyingly clear message to Western hedge funds. They're saying, if you attempt a speculative attack to crash the yen, the won, or any sovereign Asian currency, you will no longer be fighting a single, isolated central bank. You will have to fight the combined, synchronized foreign exchange reserves of the entire Pacific Rim.
And they are taking active, immediate steps to alter the fundamental plumbing of how they conduct international trade, specifically aiming to excise the US dollar from the process. The data point provided in the sources is staggering. Trade conducted in local currencies within the ASEAN region recently surged by an astonishing 163%, hitting $8.5 billion.
That specific metric represents a profound acceleration of structural de-dollarization. What we are witnessing is the rapid operationalization of the ASEAN local currency transaction framework.
Can you explain how that changes things practically?
Historically, if a massive manufacturing firm in Thailand wanted to purchase highly specialized electronic components from a supplier in Japan, the transaction inherently relied on the US dollar as the mandatory middleman. The Thai firm had to buy dollars with their baht, send the dollars to Japan, and the Japanese firm had to convert those dollars into yen.
So the dollar got a cut of the action every time. But now they are actively cutting the dollar completely out of the equation.
Entirely. They're establishing bilateral swap lines to trade directly in baht and yen. And understanding the motive behind this shift is absolutely crucial. The mainstream Western media frequently attempts to frame this de-dollarization as an aggressive, ideological, anti-American political attack.
Right, that's what you see on the news all the time.
But the underlying reality is entirely pragmatic. They are doing this for sheer financial self-defense. The nations of Southeast Asia are fundamentally exhausted by the reality that their local domestic economies are violently whiplashed every single time the U.S. Federal Reserve decides to alter interest rates, or every time an unexpected inflation report is published in Washington, D.C.
It makes sense. Why let your economy be dictated by another country's inflation?
By transitioning to localized currency trade, they are actively constructing a heavily fortified macroeconomic buffer zone against imported American volatility.
But hold on, we need to address a glaring contradiction here. You are describing this grand, structurally unified Asian financial bloc moving in complete harmony. But if you turn on any major news network for even 5 minutes, that is absolutely not the narrative being presented to the public.
Oh, absolutely not.
On television, it looks as though Japan and China are standing on the absolute precipice of actual kinetic conflict. You have the Japanese Prime Minister delivering hardline, nationalistic speeches directed at President Xi. You have governments issuing severe travel advisories, and you have both nations aggressively implementing export curbs on highly sensitive technologies like semiconductors. It has all the atmospheric trappings of a new Cold War.
It does.
Are you suggesting that behind the scenes of all this aggressive political posturing, these two nations are quietly underwriting the foundation of each other's economies?
You have correctly identified a phenomenon that geopolitical analysts refer to as schizophrenic diplomacy. It is an absolute masterpiece of strategic compartmentalization. The public, political optics of the relationship must be entirely hostile. It is a matter of domestic political survival.
Because of the voters.
Right. No Japanese politician can maintain domestic approval if they appear subservient to Beijing, and the Chinese leadership cannot project strength if they appear accommodating to Tokyo. The political theater requires aggression.
Yeah, the voting populations of both countries would absolutely riot if their leaders proposed a unified Euro-style currency.
Exactly. The concept of an officially unified Asian currency is a complete political impossibility in our lifetime. But while the politicians engage in necessary theater, look closely at the underlying economic reality hidden in the financial data. In the midst of this supposed Cold War, foreign direct investment from Japanese corporations into China actually surged by an incredible 55% over the last year.
How does an economy execute a 55% surge in investment in a hostile nation without triggering massive domestic outrage?
Through incredibly sophisticated stealth economic integration. Japanese conglomerates are aggressively deepening their investments in the Chinese manufacturing sector, but they go to extraordinary lengths to obscure the capital flow.
Shell companies.
Yes. They route the investments secretly through complex webs of third-party shell entities and holding companies located in neutral jurisdictions like Saudi Arabia or Switzerland. They meticulously preserve the hostile, combative optics for the benefit of the domestic voters and the Western media, while simultaneously deepening the essential financial plumbing that guarantees mutual corporate profitability.
There is a metaphor presented in the sources that I think crystallizes this dynamic better than any dense academic textbook possibly could.
Let's hear it.
It states that Japan and China operate like a bitterly divorced couple who still co-own and manage a highly successful multi-billion-dollar corporation together. They absolutely despise each other. They will never, ever live in the same house again, and they argue fiercely in public. But at the end of the day, they're going to keep utilizing the exact same bank accounts because the operational synergy makes them both incredibly wealthy.
It's the perfect encapsulation of the reality. They will never share a single piece of paper currency, but functionally, below the surface, their financial architectures are integrating at a breakneck pace to create a bulwark against U.S. dollar volatility.
Which is terrifying for the dollar.
Very. And when you understand that this massive, unified regional backup system is firmly in place, the Bank of Japan's stealth interventions in the currency market take on an entirely new, incredibly dangerous dimension.
Which brings us to the final act of this macroeconomic thriller. Because with the collective financial firepower of ASEAN securely guarding their flank, Japan's objective fundamentally shifts. They are no longer simply trying to fight the fire. They are no longer content to just throw a $35 billion bucket of water at a 500-degree problem.
No, they are playing for keeps now.
They are actively attempting to trigger a massive, entirely self-sustaining avalanche.
This is the ultimate endgame of the stealth interventions we discussed. The objective is not merely to temporarily halt the depreciation of the yen. The objective is to completely shatter the prevailing psychological consensus of the market. They're engineering what is known as the snowball effect.
Let's trace the mechanics of how this snowball actually forms and rolls down the mountain, because the sequence of events is both brilliant and terrifying for anyone caught in its path.
The sequence initiates precisely when the Bank of Japan deploys a stealth intervention, hurling that bucket of water into a thin market to violently artificially nudge the exchange rate down from the psychological red line of 160, pushing it rapidly to, say, 153.
Okay, so they've successfully moved the price down the mountain. What happens next?
That sudden, unexpected drop in the exchange rate instantly traps the weak hands in the market. These are the highly over-leveraged speculative funds that place massive bets, assuming the yen would weaken forever. Suddenly, They are hit with catastrophic margin calls.
So they have to cover.
To close out their losing positions and prevent total insolvency, the mechanics of the trade dictate that they are mathematically forced to enter the open market and aggressively buy yen.
Oh, I see.
This desperate forced wave of buying pressure acts as an accelerant, pushing the price of the yen even higher, which in turn triggers margin calls for the next tier of hedge funds, sparking the massive carry trade unwind. The central bank essentially tricks the speculators into becoming the very engine that drives the currency higher.
The Japanese government simply tips the first carefully positioned domino, and the sheer greed and leverage of Wall Street violently crushes itself doing the rest of the heavy lifting.
Exactly.
And then, once that momentum is established, we hit the final, irreversible stage of the snowball.
The final stage is characterized by massive FOMO corporate repatriation. Fear of missing out. Once the yen's upward trajectory is firmly established by the unwinding hedge funds, the massive real-world Japanese corporate titans enter the arena.
We are talking about companies on the scale of Toyota.
Toyota is the perfect case study. Toyota's modern operational structure is fascinating because they currently manufacture roughly 70% of their vehicles completely outside the borders of Japan.
Right.
This geographic diversification entirely shields them from the operational risks traditionally associated with a strong domestic currency. They do not care if the yen is incredibly strong when they are manufacturing and selling at Tacoma in Ohio. However, they hold hundreds of billions of dollars in accumulated profits sitting in U.S. commercial banks.
And as they watch the yen getting stronger and stronger by the hour, the corporate treasurers realize that every day they wait, their massive stockpile of U.S. dollars is losing relative purchasing power against their home currency.
Precisely. The panic shifts from the hedge funds to the corporate boardrooms. These massive conglomerates rush the exits, frantically converting their staggering U.S. dollar reserves back into yen before the exchange rate becomes too unfavorable.
So it's not just speculators anymore.
When real, physical corporate giants begin repatriating trillions of dollars of actual capital, the fundamental nature of the market permanently flips. It transitions from a fragile, synthetic, speculative bubble into a reality of massive, undeniable structural strength. The momentum of the currency trend is permanently, irrevocably reversed.
So the underlying structural fire is finally extinguished, and the snowball is now a massive avalanche rolling over everything in its path. Which brings us to the ultimate, largely helpless victim of this engineered avalanche.
The U.S. Federal Reserve.
Yes, the Federal Reserve. Because this global cascade creates what the geopolitical sources term the Fed's impossible choice.
And it is not hyperbole. The mathematical reality offers no viable escape route. If foreign buyers like Japan and China completely vanish from the market, and the violent unwinding of the carry trade forces global investors to aggressively dump their U.S. treasuries to raise cash, the U.S. Treasury faces a catastrophic lack of demand.
Somebody has to buy the debt.
Right, who steps in to buy the debt required to keep the United States government functioning. The Federal Reserve is presented with two equally apocalyptic options. Option A. The Fed is forced to step in as the absolute buyer of last resort. They fire up the printing presses and create massive, multi-trillion-dollar quantities of new money out of thin air simply to buy their own government's debt.
But executing a massive quantitative easing program, printing trillions of new dollars, at the exact historical moment when the rest of the globe is actively dumping the dollar.
Right.
That doesn't just cause inflation. That instantly ignites a hyperinflationary death spiral, right? The cost of basic living expenses in the United States goes through the roof.
Exactly. It completely vaporizes the purchasing power of the average citizen.
Yeah.
So the Federal Reserve planners look at option B. They refuse to print money, they step back, and let the free market dictate the terms.
Which means what?
They allow the massive oversupply of dumped U.S. bonds to flood the market. But without central bank intervention, the only mathematical way to attract the necessary capital to buy those bonds is to let the interest rate skyrocket. The yields on U.S. sovereign debt spike violently to 6% or 7%.
And the knock-on effects of that are devastating, because all domestic borrowing is pegged to those yields. If U.S. Treasury yields are sitting at 7%, then a standard 30-year fixed mortgage for an average American family is suddenly hovering around 9% or 10%.
Easily. It instantly and entirely crushes the domestic housing market. It makes the cost of corporate borrowing so prohibitive that businesses halt all expansion and begin mass layoffs. It triggers a brutal, grinding, multi-year economic depression.
So it's hyperinflation that destroys the currency or a deflationary depression that destroys the economy?
That is the parameters of the impossible choice.
I have to ask the obvious, overarching geopolitical question here. If this engineered snowball effect threatens the core stability of the United States economy this drastically, if it literally forces the Federal Reserve into a nightmare scenario that could break the middle class, will the United States government simply sit back and allow Japan and the ASEAN bloc to execute this maneuver? Won't Washington deploy its massive geopolitical leverage, pick up the phone, and forcefully demand that Japan stop the interventions immediately?
That is the ultimate quiet genius of the multi-decade trap that Japan has methodically laid. The United States finds itself utterly lacking the traditional levers of power required to halt the process. Recall the architecture of the risk pyramid we discussed.
Right, the pyramid.
Because Japan's massive national debt is almost entirely internalized and owned by its own citizens and central bank, the U.S. Treasury cannot threaten them with a sovereign debt crisis or financial embargo.
They don't owe us money, they owe it to themselves.
Exactly. And because the Asian nations are collectively executing their shift to local currencies strictly under the diplomatic banner of financial self-defense against imported volatility, the U.S. State Department cannot easily frame them to the global community as malicious, aggressive currency manipulators.
So they are completely insulated from the accusation of attack. They are simply taking prudent steps to survive.
Exactly. They can accurately claim they are loyal, long-standing allies who are simply trying to prevent their own domestic populations from starving due to inflation imported from Washington.
So America's hands are tied.
Completely. For the United States to attempt aggressive punitive measures to stop them would instigate a massive, irreparable diplomatic rift with the entire Pacific Rim at the exact historical moment when the United States desperately requires their unified alliance to counter the rising military and economic influence of China. The United States has been perfectly immobilized by its own systemic dependency on the continuous inflow of cheap foreign capital.
It is a breathtaking reality check. We have covered an immense amount of complex terrain today. We have traced the invisible architecture of a $100 trillion mountain of digital ghost yen. We have decoded the frantic, highly tactical Golden Week ambushes executing in the dark pools. And we have pulled back to reveal a 90-year strategic master plan that is finally ruthlessly catching up to the hubris of Western short-termism.
We are bearing witness to a profound structural shift in the fundamental mechanics of global power. It is happening in real time beneath the surface of the daily market ticker.
And to you, listening to this deep dive, the previously invisible landscape should now be coming into sharp focus. You now understand the mechanics of the invisible mortgage that is currently attached to your own portfolio. The next time you see your reliable tech stocks experience a sudden, inexplicable midday plunge, or you see domestic mortgage rates tick inexplicably higher despite what the politicians are promising, you will know to look past the domestic headlines.
You'll know where to look.
You will know to look toward the silent actions of the central bank in Tokyo.
The vast, complex plumbing of the global financial world is almost entirely ignored by the public, until the exact moment a pipe violently bursts. By analyzing these specific pressure gauges in May 2026, we are watching the systemic pressure build to a truly critical threshold.
We are. So we're going to leave you with a final thought to mull over today, a perspective that builds on everything we've uncovered. We have been conditioned for generations to measure global superpower status in incredibly traditional, visible terms. We look at a nation's gross domestic product, we count the number of warheads in its nuclear arsenal, or we measure how many aircraft carrier strike groups it can project into the ocean.
The old metrics of power.
Right. But when the fundamental prosperity of the entire Western financial system, the tangible value of your retirement account, the basic stability of your local housing market, the continued survival of Silicon Valley innovation is structurally tethered to the quiet interest rate decisions of a single, highly patient central bank operating in Tokyo. It forces us to ask a terrifying question. Who is the true superpower in the 21st century? Is it the loud nation with the biggest, most heavily funded military, or is it the quiet, patient nation whose finger rests firmly on the kill switch to the world's mandatory debt? Think about that the next time you log in to check your portfolio, waiting to see exactly where the falling knife finally lands. Keep questioning the prevailing consensus, always look past the surface headlines, and keep learning.